Now here's where this stops being theory and starts becoming a countdown, because arbitrage isn't just failing, it's refusing to engage. A $13 gap between New York and Shanghai is not a market inefficiency. It's a physical impossibility signal. It's the market saying, there's nothing left to move. In a functioning system, traders don't hesitate. They don't debate sentiment. They don't wait for confirmation. They execute. So the fact that no one is stepping in to close this gap tells you everything you need to know. There is no silver available at the New York price. Not in size, not for export, not for delivery. This is where the paper illusion breaks. Because paper silver only works as long as no one asks for the metal. And now, everyone is asking. That's why the next signal mattered so much. The US Mint quietly suspended Silver Eagle sales. No emergency announcement, no press conference, just gone. Why? Because the Mint could not secure silver blanks at the COMEX price. They were being outbid by the physical market, by buyers paying Shanghai prices. That's not a supply issue. That's a pricing failure. When a government mint can't source metal at its own quoted price, the price has lost authority. That moment should have stopped the market cold. But instead, it accelerated. Because once confidence cracks, it spreads. Now let's talk about the vaults. This is where things turn irreversible. Over just 24 hours, millions of ounces were withdrawn from major depositories. Not shuffled, not reclassified, removed. This is not trading behavior. This is withdrawal behavior. This is what a bank run looks like. In metal, institutions aren't trying to make money here. They're trying to remove risk. They're trying to escape counterparty exposure. They're trying to ensure delivery while delivery still exists. And the delivery numbers confirm it. January 2024, 8 million ounces stood for delivery. January 2026, 34 million ounces. That is not speculation. That is a structural loss of faith. Because futures markets are not built for delivery. They are built for rollover. They are built for settlement. They are built on the assumption that only a tiny fraction will ever demand the real thing. That assumption is now broken. This is what fractional reserve failure looks like in commodities. Too many claims, not enough metal. And suddenly, everyone wants to be first. Now watch what happens next. The banks, the same banks that spent decades suppressing silver prices, the same banks that shorted rallies into exhaustion, they're flipping, not slowly, violently, forced covering. Short positions, unwinding into an empty market, and when shorts cover into no liquidity, price doesn't rise, it jumps. This is why silver doesn't move smoothly. It gaps. It teleports. Because when sellers disappear, price discovery collapses upward, and gold confirms everything. Gold doesn't spike like this unless the system is under stress. Gold doesn't break records on speculation. Gold moves when trust breaks, when capital seeks refuge. And silver, smaller, thinner, more volatile, absorbs the overflow. Silver is not leading this. It's being dragged. And once it's dragged, it overshoots. Now layer in industrial demand, this is the final accelerant. Manufacturers don't care about charts. They care about continuity. If silver is required to keep factories running, price becomes irrelevant. Availability becomes everything. So rising prices don't reduce demand. They increase it. Because higher prices signal scarcity. And scarcity triggers hoarding. This is how feedback loops form. Price rises, buyers panic, inventory disappears, price rises more. There's no equilibrium here, only escalation. And the physical market has already detached. In India, real silver trades north of $130. In Asia, premiums are exploding. Dealers are rationing supply. Some are refusing orders entirely. This is what price control looks like just before it fails. The retail wave hasn't even arrived yet. This move has been institutional, arbitrage, delivery, industrial procurement. Retail comes later. Retail comes emotionally. Retail comes when headlines turn from volatile to historic. And when retail hits an empty market, that's when the final vertical move happens. So understand this clearly. The COMEX is not leading anymore. It is lagging. It is reacting. It is being dragged upward by a physical market it no longer controls. This is not a silver rally. This is a price-setting regime change. The East now sets the price with metal. The West marks it with paper. And paper always follows until it breaks. The gap will close. But not by Shanghai falling, by New York being forced higher. Violently. This is not fear. This is not hype. This is what happens when leverage meets limits, when promises meet inventory, when confidence meets reality. And once systems reach this stage, they don't unwind politely. They reset. And the only question left is, will you be holding the paper or the metal? Now let's zoom out, because silver is not acting alone. Silver is signaling, and what it's signaling is a breakdown in how trust itself is priced. Because markets don't collapse when prices rise. They collapse when belief fails. For decades, the global system ran on one assumption, that paper claims were as good as physical ownership. that futures contracts, ETFs, unallocated accounts, and digital promises could all be treated as metal. And that assumption worked right up until stress entered the system. Stress changes behavior. Stress exposes lies. Stress forces delivery. And delivery is where paper systems die. What you're witnessing right now is not volatility, it's validation. Validation that the law of one price only exists when physical supply is abundant. Validation that arbitrage only functions when logistics are possible. Validation that trust is conditional, not permanent. The silver market is now operating in two realities at once. One reality is financial, the other is physical, and those two realities no longer agree. In the financial reality, price is set by leverage, by margin requirements, by algorithmic liquidity, by settlement assumptions. In the physical reality, price is set by necessity, by industrial demand, by sovereign accumulation, by custody and control. When these realities diverge, something must give, and it is never the physical side. This is why the gap matters more than the price. A $13 spread is not a number, it's a confession. It's the market admitting that paper silver cannot access physical silver, that the mechanism connecting the two has seized up. Once that happens, price discovery migrates. It doesn't negotiate, it doesn't wait for consensus. It moves to wherever the metal is flowing, and right now the metal is flowing east, Shanghai, Dubai, Mumbai. These are not speculative hubs, these are consumption hubs, places where silver is used, stored, hoarded, and never returned. Once silver enters this corridor, it is effectively removed from the Western float, forever. That's why inventory drawdowns don't reverse. That's why withdrawals accelerate. That's why eligible metal quietly disappears. Not because demand is hot, but because confidence is gone. And here's the part most people miss. This isn't a silver problem. This is a paper problem. The same structure exists in bonds, in currencies, in derivatives, in equities. Silver is simply small enough and physical enough to crack first. That's why it moves like this. Fast, violent, unforgiving. Silver doesn't give you time to think. It forces decisions. And now the market has entered what traders call blue sky territory. There's no historical resistance above, no price memory, no overhead supply, only psychology. And psychology breaks far faster than charts. When prices move $10 in a day, it doesn't scare buyers away. It scares sellers into hiding. Because nobody wants to sell something that might be unavailable tomorrow. This is how markets lock. This is how price gaps widen. This is how liquidity vanishes. The most dangerous instinct right now is profit-taking. Because selling into a currency confidence event is not locking gains. It's swapping certainty for promises. It's trading the lifeboat for a receipt. And this is why the most explosive phase is still ahead. What you're seeing now is institutional positioning, balance sheet protection, delivery arbitrage, industrial panic. Retail hasn't arrived yet. Retail arrives when the story simplifies, when headlines turn binary, when price moves become dinner table conversation, when silver stops being volatile and starts being unavoidable. That phase doesn't add liquidity, it removes it. So here's the reality check. This is not about predicting prices. It's about recognizing regime change. It's about understanding that once pricing authority shifts, it does not come back. New York lost price control the moment it could not deliver, the moment the mint stood down, the moment arbitrage froze, the moment vaults emptied faster than they could be replenished. From here forward, price is reactive. It chases availability. It chases custody. It chases the physical bid. The only chart that matters now is inventory. The only signal that matters is delivery. The only truth that matters is possession. This isn't chaos. It's transition. From paper convenience to physical reality. And history shows us exactly how that transition ends. Not slowly, not gently, but all at once. This is the part of the cycle where doing nothing feels safest, and where waiting costs the most. Because when systems reset, they don't offer re-entry. Silver is not flashing green. It's flashing red. Not danger, but warning. Warning that the system you trusted to price reality no longer can. And once that understanding clicks, the noise fades, the volatility becomes irrelevant, and the question simplifies to one thing: do you trust the promise or the metal? Because in the end, only one survives the reset.